Lesson 5, Fundamentals versus Technical Analysis. Now, whereas retail market participants are concerned, or persons like regular persons like you and me, there are essentially two schools of thought. Even though all of us are trying to extract a profit from the stock markets, there are generally two approaches. One is called the fundamental approach, and the other one is called the technical approach. So first, I will give you an idea of what the fundamental approach is all about. So where the fundamental approach is concerned, these persons believe that all you need to focus on are the underlying fundamentals of the business, the sales, the risk factors and things of that nature. And then they use this information from, the annual statements and the quarterly statements, the sales and so on, and the data provided by the company to make forecasts, about future cash flows. And then they try to come up with a present day value based on all this data. So what fundamental investors look for are discrepancies between how the open market is currently valuing the company versus how their models value the company based off the same information. So, a fundamental investor might look at a report like this, for instance, and then they might realize that the way that Apple is reporting, for instance, the value of their real estate is not currently reflected in the stock's price. So they might decide, hey, let's make a big investment in the stock now, because as the other market participants start to realize this mispricing of the real estate is going to result in the price of Apple going higher, and we're going to make a profit this way. This way is feasible. However, it requires large amounts of resources, teams, intelligent people, models, expensive software, and so on, right? Now, there's the other school of thought where we focus on what is called technical analysis, or just the price, the pure price of the stock, of the stock. So in the second school, we understand that yes, the future sales, and what's not, and business risk factors and things like that are going to influence the price. However, in this school, it is believed that everything is basically already reflected in the current price on the chart, and all we can do is just basically go with the flow, go with whatever the chart is telling us. So if the chart is telling us prices are likely to go higher, then we look for opportunities to go long. If the chart is telling us the price is going to go lower, we look for opportunities to go short. And if the chart is telling us the price is going sideways, then we might stay away and wait until price breaks to the upside or to the downside. Now, so charting gives us a visual representation of a stock's price. Now, more specifically, we use this chart that you're looking at, which is called candlestick chart. Now, the reason why it's called a candlestick chart is because it shows us the highest price achieved in the day. So if you look at this candle, for instance, the highest price achieved for the day was 646.5. The lowest price was 637.25. Opening price, or the first price for the day, was 637.76, and the closing price was 645.31. And you can tell by the candle being white that the closing price was higher than the opening price. So the reason why we use candlestick charts is that in an instant, just by looking at the a single candle, we can already tell the high, low, and whether the close is higher than the open. Okay. In addition to these, we can immediately see how much volume or how many shares traded hands during the time period. So for this specific chart that we're looking at, each candle represents one day. One day's trading are from 9:30 a.m. to 4 p.m. Okay, so this tells you exactly the highest price, lowest price achieved during that time on a particular day, and the open and the close. Okay, so that's why we use candlestick charts. It's convenient, and it's an efficient way of presenting the information to us as traders. Now, the second major thing that you're going to notice are these lines: this green line, the blue line, the orange line, and the brown line. Now, these are called moving averages. So the green line is the 9-period moving average. So at this specific point in time here, right, the green line is about 658. So what this is saying is that the average price for the last 1, 2, 3, 4, 5, 6, 7, 8, 9 candles, the average closing price is 658. So the average price 9 days ago was 647, and the average price 9 days later 658. So what this is telling you is that the average price for the last 9 candles is increasing. Therefore, the price is in an upward trend. And so too, the 20, it does the same thing. anything except it takes into consideration the past 20 candles instead of the past 9 candles. And this one is called a 50 period moving average. This one takes into consideration the past 50 candles. And then this brown line is called a 200 moving average because it takes into consideration the last 200 days. So what we're looking for is when the average price for the last 9 candles is higher than the average price for the last 20, and the average price for the last 20 is higher than the average price for the last 50, and so forth, then this is telling us we should only be looking to get long the stock or stay out of the market. And conversely, if the 9 period moving average is below the 20 and the 20 is below the 50, this is telling us to look for opportunities for shorting or to profit as price declines or to stay out of the market. Now, the next thing you're going to notice is this gray line. This is called a Bollinger Band. Now, the way I have it set up is that this tells you what is 2 standard deviations away. What price is 2 standard deviations away from the 20 period moving average at this particular time. The reason why I keep this on my chart is, generally speaking, when price gets extended more than 2 standard deviations, right, from the moving average, then it's generally going to revert, like you see here. So you see there are 3 candles outside, and then boom, price snaps back. Similarly here and so on. So it's not a perfect indicator, but when price gets extremely extended, you can see there's a general tendency for it to snap back towards the blue line. So this is called the Bollinger Band. And then in addition, you're going to see these bars at the bottom of the screen, like I mentioned earlier. These are called the volume bars. All these tell you how many shares traded hands between buyers and sellers for the particular time period. And then there's this other blue line called the average true range. So this blue line tells me, it gives us the average of the difference between the high and the low for the past 9 days. So the range of each day, right? So it gives us an average of how much a stock is likely to move in a particular day. So if the market opens and the SPY, for instance, moves 7 points within the first 10-15 minutes of trading, then we know it is very likely the price will mean revert instead of continue trending, because it has already moved about how much we can expect it to move for the day, basically. Now, this applies on days when there are no news or other extraneous factors influencing the stock's price. So on days when there are news events, right, that can trigger unusual price, like you can see here and here, stocks can move sometimes 2-3 times or even more the average true range, right? So that's the average true range. And then the final thing that we're going to look at is called support and resistance. So basically, every time you see price going up and then it stops and then pulls back like this level is called a resistance level, because the sellers here, the amount of selling pressure that came in here was enough to trigger a reversal in the price movement from here down to this point here, right? So this is called support and this is called resistance. So price breaks this resistance level, it pushes up and then it reverses here again and forms what is called another level of resistance. So this is called daily resistance because we're on the daily chart. If we go to the monthly chart, then we can see the same things here. So this is a monthly level of resistance at 479, and this is a monthly level of support at 348. So let's say price had hit resistance here and was pulling back. Then, if we were looking for opportunity to buy, we would be waiting until price gets down here to support to see what it's likely to do. Instead, it found support here, found resistance here, and then it broke the resistance and start trending up. And if you look on the price pull back here in April of earlier this year, look where it bounced. It bounced from this prior pivot high or this support level. So this was once resistance. What was once resistance turns into support, right? Now I'm not gonna be able to comprehensively cover technical analysis, in its entirety. I'm only giving you what you need to make money day trading. Okay. However, I encourage you to go and do further reading. There are many books, YouTube channel, etc. that delves deeper into technical analysis, but you don't need to get too complicated. All you need is just the basics, just to get you going. Right. So this is just a brief introduction to the technical analysis. We're going to make a deeper dive in lesson 6.